Generally, if a company insists on you having a car for work, they'll have proposed solutions as to how you source that car. These are most likely a car allowance to buy or lease your own car, a salary sacrifice scheme to lease a car, or an expensed company car. Today, I'm going to explain each option, cover some of the ins and outs of each, as well as some of the pros and cons, to maybe help you decide which is the best option for you, the employee, if you're lucky enough to be able to make that choice. I should start by outlining that I'm not a financial advisor. The figures I will take you through are from my own research and calculations, and I would always advise you to take professional advice if you feel you would benefit from it. Hopefully, I'll just demystify elements of the processes. Now, for jobs which need a car to complete the role, how you, the employee, source that car can vary massively in terms of costs, both you and the employer. There are also pros and cons of each way of acquiring your vehicle, but the one thing they have in common is that if an employer has any kind of car scheme, it's generally because they expect you to always have access to an operational vehicle. Now, this isn't the same as an office pool car, which numerous people have access to. It's a car which is primarily used for work and you are generally the exclusive user of. Now, let's start with the first of the options, the car allowance route. Now, what this means is when a company pays a fixed amount over and above your salary specifically to ensure you have a car. You'll be taxed on this money in the same way you are taxed on your salary, and then you have the option of either buying a car or taking a personal lease. The main advantage of the car allowance route is choice. Your employer might have criteria that they expect you to adhere to, especially if you're customer facing and your car is part of how you represent your employer, but the only other limit to your choice is how much you want to spend. If it matters to you and you don't mind the outlay, you can spend more than your post-tax car allowance and buy or lease something that you maybe wouldn't normally be able to afford if you weren't receiving an allowance. Starting with the personal lease option, you can literally choose any car you like over various periods of time, ranging from 12 months and up to 48, maybe even 60 months. You can even add a maintenance package which includes all servicing, road tax and even tyres in the monthly price. There are lots of lease companies in the market, many of which will have exclusive deals, so it pays to shop around and see what's available. It might even be advantageous to not have a specific car model in mind, but more a car type, and then you can see who can offer you the best car for the best money. Now, if you decide to use your car allowance to buy a car, then your next decision is whether to buy new or used. Again, your employer might have a rule about how old your car can be, so be sure to check before you're excited to log on to Auto Trader. Now, if you're buying a brand new car, you have three dominant options: paying in cash, hire purchase, and personal contract purchase, or P.C.P. If you can afford to buy your car in cash, then happy days, but it's fair to say that most people won't fall into that camp. Hire purchase is the next option, and this is a simple case of buying the car with equal monthly payments, including an interest charge, over an agreed period. Essentially, it's a loan from the car retailer and can often have quite a high percentage on interest compared to shopping around for a loan elsewhere, so be cautious. The most popular option in the UK is the P.C.P scheme, or personal contract purchase. Now, while this is a little more complicated, it does best fit the objectives of most buyers and dealers. What this entails is putting down a deposit of your choice, paying a monthly amount, and then after an agreed number of months, paying a balloon figure to own the car. Or, instead of paying the balloon, handing the car back in exchange for a brand new car, using any collateral in the car as your next deposit and starting the whole process again. Now, predictably, dealers would rather you trade the car in. And so for many buyers, that suits them perfectly, always being a car that's within warranty and never gets old enough to need an MOT, which of course is compulsory when the car reaches 3 years old. Now, the monthly amount you pay on a P.C.P is dictated by the anticipated depreciation of the car over the duration of the agreement. So, for example, if a car costs £40,000 new, and you want to take a P.C.P over 3 years, and the car dealer estimates that the car will be worth £20,000 after 3 years, then £20,000 becomes your balloon figure. And your payments will be calculated as follows: the full cost of the car, so £40,000, minus whatever discount you can negotiate, and make sure you do, because you're buying a car new, you should definitely negotiate some discount, and then of course what deposit you place. Once you take that 40,000 minus the discount minus your deposit, that's your starting point. The dealer will then apply whatever level of interest you've agreed to the whole amount, including the balloon, because essentially you're borrowing the full balance. They would then remove that balloon balance from this new figure and divide that by the number of months to give you your monthly payment, basically. So easy enough, right? Well, if it's not, that's why it's so important to make sure you fully understand any P.C.P proposal you receive, including how the interest is applied and any additional fees which may be in the mix. It can make quite a difference and they're not always obvious. Likewise, make sure you understand the logic behind the calculation of the balloon figure, as it's generally designed to ensure you have some collateral in the car so dealers can entice you into a new car with a good deposit. And that means you make higher monthly payments, but at the end of it said you've got a deposit for your next car. Make sure you ask lots of questions. Make sure you have options depending how big a deposit you're willing to place. And do not be shy about negotiating the potential variables, which in this case are the price of the car itself, the interest rate, and the size of the balloon. And any fees, I suppose, but they probably fall into the interest rate section. Okay, but alternatively, you could be shrewd and buy something used instead of new, something that's already taken a hit of depreciation. You could even buy something that costs less than your car allowance, meaning you could make money both each month and when you come to sell it, because essentially your employer has bought you a car. That's the point. You can choose. Now, I personally have had a car allowance from work for the last 9 years, and I've bought some fabulous vehicles, ranging from a brand new Volkswagen California camper van, which lost very little money over the time I owned it, and to my current Audi Q7, which I bought used so that someone else had taken the huge hit of initial depreciation. Now, they both cost more per month to buy than my monthly allowance, and I couldn't have afforded them without the allowance, but the depreciation on both vehicles was actually very similar to my car allowance payment. So even though I spent more, the actual cost to me was pretty much in line with my car allowance. So bear in mind, you will have to do some maths when you're working this out. However, it's not all good news when shopping with your car allowance. Starting with leases. If you lease a car, you have to be able to put a deposit down, which is generally anywhere between 3 and 9 months rental up front, which is inevitably likely to run into thousands of pounds. And of course, you're never going to own that car. Inevitably, the smaller the deposit you put, the bigger the monthly payments. They will get their money from you one way or another. So be aware that the lease company will also fine you if you hand it back at the end of the agreement with either more miles on the clock than you agreed to or any damage to the car. If you've got both, expect to get hit with a fine. On top of that, you'll still have to insure the car yourself. Even if you take a full maintenance package, and in my experience, insurers like to charge a little more when you insure a lease car as you're not the legal owner. However, on the plus side, you will build up a no claims discount for insurance, which is a plus. So likewise, if you buy a car, unless you pay extra for maintenance package as part of the purchase mechanism, you are responsible for paying for the running and maintenance of the car, which will include servicing, road tax, roadside assistance, tyres, MOT, any extended warranty, and of course, insurance. You are going to have to stretch that car allowance quite a long way. Lastly, remember that a personal lease and hire purchase or PCP agreement is a financial agreement, which means you'll have to have decent credit to get the agreement in the first place. And that once it's set up, it will be on your credit status, which could be relevant if you're looking to apply for a mortgage or additional debt during the lease period, which you are then tied into. However, taking all these pros and cons into account, if you like virtually unlimited choice and want to potentially own a car and have the option, then a car allowance could be absolutely perfect for you. Next up is salary sacrifice. Now, the principle is exactly what it sounds like. You give up a portion of your salary to pay for a car lease. But what makes it appealing is that you give up this money before paying tax and national insurance on it, so you save. So salary sacrifice schemes where you avoid paying the tax on a product or service are not uncommon benefits offered by an employer and can often include paying for a gym membership or childcare, additional health benefits, or probably the best known salary sacrifice scheme in the UK, the Cycle to Work scheme. I believe so far over 1 million bikes have been bought in the UK on this scheme and then paid for over a series of months direct from the rider's pre-tax salary. You'll notice that all the salary sacrifice benefits I've listed are focused on the employee and their family's well-being or health. Well, the rules on salary sacrifice for cars were changed by the government in 2017, so the benefit became equally specific in its intentions. Let me explain. But before I do, I should start by explaining what benefit in kind tax is and how it works, as I'm going to be discussing that quite a bit from this point on. So, when related to a car, the amount of tax paid for a benefit in kind is calculated using three pieces of information: the list price of the car, the emissions of the car, and the personal tax rate. So basically, the emissions of the car dictate a percentage tax rate which you will have to pay on the value of the car. The lower the emissions, the lower the tax rate. For example, a fully electric car which produces zero emissions attracts the lowest benefit in kind tax rate of just 1% in the 2021 to 22 year, rising to 2% for the next 2 years. Whereas a high emission car, such as a large engine petrol or diesel, will attract a tax rate of anything up to but not exceeding 37%. Therefore, as an example, if someone is a 40% taxpayer with a £40,000 electric car which attracts a 1% benefit in kind tax rate, the tax which they would pay is 40% of, so that's their personal tax rate, 1% of, which is the taxable rate, £40,000, which is the value of the car. So 1% of 40,000 is 400, 40% of 400 is £160, or £13.33 a month. That would be the benefit in kind tax, or you may hear people refer to it as the company car tax. However, if that same 40% taxpayer was driving a high polluting car which cost the same £40,000 but had a benefit in kind taxable rate of 37%, the maximum, they would again be paying 40%, their personal tax rate, but this time of 37%, which is the taxable rate, of £40,000, which is the taxable value of the car. 37% of £40,000 is £14,800. 40% of that is £5,920, or £493 a month. Now, if you compare that to the £13 tax bill for the electric vehicle, you can quickly see that emissions definitely matter when choosing your car, both for the environment and your pocket. So, back to the salary sacrifice scheme and the rules relating to cars since 2017 and the government's changes. The way it works now is that you no longer completely avoid paying tax by using the scheme to lease a car. Instead, you have to pay tax on either the salary you give up on the scheme at your normal tax rate, which means the only benefit is a potentially better lease deal, which your employer can likely negotiate over you shopping as an individual, or you have to pay the tax on the benefit in kind of the value of the car you lease. Unfortunately, you don't get to choose which tax you pay. The rules now say that you pay whichever is the highest. But, and this is an important but, there is an exception to the rule, and here's the objective of the scheme post-2017. If the car you choose has less than 75 grams per kilometre of CO2 emissions, which would generally have to be a hybrid or a fully electric car, you'll only have to pay the benefit in kind, regardless of if it's less than the tax you would have paid on the portion of the salary which you sacrificed to pay the lease. Which means it's not a case anymore of just paying the highest, you automatically just pay the benefit in kind. As you may have guessed, the salary sacrifice scheme has a very clear goal now: get emissions down by putting people into more efficient cars. So to clarify, if that same 40% taxpayer I mentioned earlier used the salary sacrifice scheme to pay for a business lease on a car, they would be getting a £600 a month or £7,200 a year car lease by sacrificing money which, had they not used the salary sacrifice scheme, they would have been taxed at 40% and left them with £360 per month take home, or £4,320 a year. So brilliant. £4,320 versus £7,200 worth of lease, they literally saved £2,880 a year. However, this is where the choice of car makes all the difference. To illustrate, if they used that £600 a month lease to lease a high emission car costing £40,000, then we worked out earlier that the benefit in kind tax they would have to pay would be £5,920 a year. Now remember, for cars above 75 grams per kilometre of CO2 emissions, the rule now is that you have to pay whichever is the highest between the tax which you would have paid on the salary you sacrificed or the benefit in kind tax on the car. Now in this case, the £5,920 benefit in kind is higher than the £2,880 tax which was saved, and so that is what the government would charge the driver in tax. But that's not all. Combine that £5,920 benefit in kind tax with the £4,320 a year take-home wages that they sacrificed to join the scheme, and that gives a grand total of £10,240 a year. They would, in fact, have been over £3,000 a year better off if they didn't join the scheme and just paid the £600 a month from their post-tax wage for the lease. Not really much of an incentive. However, if they use that £600 a month salary sacrifice to lease an electric car with zero emissions, we know from the earlier example that the benefit in kind will be just £160 a year. And that, because it has emissions lower than 75 grams per kilometre of CO2, as per the 2017 rule, this is the only tax they would have to pay. Combine that figure with the £4,320 of take-home wages that they sacrificed, and they have a £7,200 year lease for a combined true cost of £4,480. That is worth doing. Now, obviously, I've already covered the advantages of a lease in terms of choice and package, and that includes service, road tax, etc. But there are additional benefits of taking a lease through the salary sacrifice scheme. Firstly, in comparison to a personal lease for one car, your employer will potentially have much better negotiating power than you, especially if others within the company are on the same scheme, meaning you could end up with more car for your money or the same car for less money. Plus, and this is a big one over personal lease route, you won't have to pay a deposit or have to go through any credit checks to join, as you aren't personally entering into a financial agreement, your employer is. Remember that, much like with a personal lease, you would still have to pay for insurance, any excess mileage, and damage to the car when you hand it back. There's lots to think about if this option is on the table for you, but it's very clear that an electric or a hybrid vehicle is definitely the best way to make the most of this scheme. Or, if you do have your heart set on a less efficient vehicle, you may be better off not joining the scheme and just financing it directly. Last, but very definitely not least, is the company car option. Now, this is where your employer issues you with a car from a list of choices and then you pay benefit in kind tax on it. Now, I'm going to start with the negatives for this option. Firstly, in many cases, your choices are only as long as the list which your employer gives you. Now, you're unlikely to have the freedom to choose anything not on the list, meaning that if all the cars on the list are relatively high emission cars, then you're going to be facing a benefit in kind tax bill that you won't like, and there's nothing you can do about it. Plus, you'll probably be stuck with the car for the duration of the lease, which can be anywhere between 3 and 5 years. You will likely also be limited on options in the car, as companies don't want to pay increased lease prices on extras, especially as there's always the risk you might leave employment during that car's lease, and they're left paying the bill or passing it on to the next person who would rather not be paying for options that they didn't choose. Choosing the colour might be as good as it gets, I'm afraid. However, these negatives aside, if you like the list of cars, and especially if they have low emission options, then the company car is an incredible option that can work out by far the best value for money if you're willing to sacrifice the wider choice. As the car is being supplied by the company and the lease agreement is with them, there are no ongoing maintenance costs for you, the driver, as they're part of the company's lease agreement costs. The company will also likely pay for a group insurance policy, so that won't cost you either. Now, obviously, this means you aren't building a no-claims bonus, but if you do leave the company car scheme in the future and want to insure a personal car, most lease companies will write you a letter confirming if you haven't had any accidents, assuming you haven't had any accidents, and a lot of insurers will honour this to give you a no-claims bonus. So once you've been with that insurer who honoured the letter for just 1 year and you still haven't had any accidents, you can insure with anyone else using your new cumulative no-claims bonus without any mention of having some of it come from a company car. Now, another huge benefit, which I've touched on when talking about personal leases, is mileage. Now, when you have a personal lease, you have to keep an eye on mileage to ensure you don't exceed your agreed limit. If you use the personal allowance to buy a car, you will always have mileage in the back of your mind, I promise you, either because you've taken it in a P.C.P, which also has a mileage limit, or if you bought the car outright, you know that each mile you put in the car is aiding its depreciation. Now, when you have a company car, mileage is no longer an issue. The only time it might come up is because some company car leases run until either a period of time has passed or a certain mileage is reached. Whichever happens first, you then get to choose a new car. So if the only thing you do pay is the benefit in kind tax, then let's go back to the earlier example. If you're a 40% taxpayer with a company car worth £40,000 that has high emissions, you will be lumbered with a benefit in kind tax bill of up to £493 a month. Obviously, if the car is worth more at list price, because the benefit in kind is calculated as a percentage of the car's list price, then the bill will inevitably be higher. Now, of course, if you really want a big 4x4 for both work and personal use, then £493 or whatever the benefit in value ends up being for a more expensive car is actually probably less than you would pay to buy or lease the same car, so it might actually be perfect for you. However, if you're a 40% taxpayer and your company offers you an electric car which meets all your needs and is worth £40,000, your benefit in kind tax bill will be a little over £13 a month. And that's it. No maintenance or insurance premium to pay, and both you and your employers are making a positive impact on both the environment and your pocket. Now, undeniably, there are other elements to take into account, such as how you pay for and are reimbursed for your business mileage and your personal mileage by your employer, and the impact of that on your tax code. But all of that's dependent on your employer's specific policy and a series of different rules from the government. It's also affected by the miles per gallon or miles per kilowatt, if it's an electric car, of your car. But I'll go into detail on that in another video, where I'll show a direct comparison between the costs of a selection of company cars versus a selection of personal cars. At this point, I'm just focusing on the costs of having the car before it drives a single mile. Now, finally, I think it's probably time to explain why I've made this video. Quite simply, this is a comparison process that I've been through recently, and I know I would have found this information hugely useful, so I hope you have too, especially if you stayed with the video for this long. So, what conclusion did I reach? As I mentioned earlier, I opted out of my employer's company car scheme 9 years ago. Basically, I was unhappy with the limited choice of cars available to me through the scheme, and one of the reasons I actually moved employment to this employer was the prospect of being able to opt out and take a car allowance. So I did it. Now, I currently drive a lovely Audi Q7, which, had it been a company car, which I should mention I'm nowhere near senior enough to ever had the option to take, it would have cost me more in monthly benefit in kind tax than the monthly repayments I'm making now. However, the company car scheme has moved on, and in line with more and more companies making a concerted effort to reduce their carbon footprint, the Tesla Model 3 Standard Plus has now arrived on our company car scheme. Now, obviously, I've had to take into account the luxury and fantastic versatility of the Q7 against the cost of financing it, maintaining it, and running it. Plus, of course, the environmental impact. I've reached the conclusion that it's the right thing to do to sell it, give up my car allowance, and rejoin the company car scheme with a Tesla Model 3 Standard Range Plus. Taking into account my anticipated mileage, the economy of the car, the cost of diesel versus electricity, the company's reimbursement rates, and the £13 a month benefit in kind tax cost, I estimate I'm going to be around £4,400 a year better off in terms of outlays. Of course, however, I'm not going to have an asset at the end of it all, but that's a sacrifice I'm willing to make. Therefore, for me, the ultimate car is a company Tesla. I know the Model 3 isn't everyone's cup of tea, and to be honest, there are a lot of awesome electric cars appearing on the market each month. But I'm a gadget nut and a car fan, and the Model 3 is basically two of my favourite things combined into one huge selling package. In fact, the Model 3 was actually the highest selling car in the UK last month, which is June 2021. And for me, looking at the numbers and enjoying an amazing test drive in the Model 3 earlier this month, which was incredible, and I'd recommend it to everybody. Brace yourself, because here comes the straight road. That's just insane. It's brilliant, but it's insane. It's not difficult to see why I've made the choice. Now, no doubt I will post some videos about the car when it takes delivery in September, and I'll try and make them look in some way different to the millions of other YouTube videos about Teslas, but I can't wait. Anyway, in the meantime, thank you so much for watching, and if you found this video useful, please do give it a like. It would help me a great deal if you subscribe to my channel by clicking below. Your support makes it worthwhile for me, and of course, you're not obliged to watch everything that pops up. Also, if you have any friends or colleagues who would benefit from the insight I've shared today, don't forget to click share below and send the link to them so they can watch the video too. Thank you very much. See you on the next video, which is, I think, going to be about solar panel upgrades and the Tesla Powerwall that we're having installed in 2 weeks. And I'll speak to you soon. Take care. Bye-bye.